So economics, of course, is the science of explaining tomorrow why the predictions you made yesterday didn't come true today. And so we're going to take a look, since we've looked at the past, to say, okay, well, where does this suggest that we might be considering for returns in the future? So The Economist came out with an analysis about a year ago saying that depending on where the stock markets are priced, where interest rates are priced, where income rates or cap rates on real estate are priced, you can make some prediction over the next 10 years about future returns. So in this particular case, if you look here, you know, this is 1932, 33, right, that peak there. With stocks so depressed and deflation occurring, the next 10 years returns for a balanced portfolio were 13% compounded a year. So if you were great on market timing, this was the time to get that done. And the same thing was true in the late 80s when interest rates hit 18 or 19%. Basically, for the next 10 years, the returns were staggering. Of course, people found it hard to see it at that point in time. Here, the expected future return based on the way assets are priced today is that if you're lucky, you'll get a 2% real rate of return for the next 10 years in a balanced portfolio. And if our objective is to get double that, as a 4% real rate of return is the objective net of fees and inflation, then that means you will be swimming uphill. Actually, not uphill, upriver, right? So let's take a look at how this has performed in the past. This is a graph of conservative, moderate, and risk investors as traditional asset allocation would suggest. So we have to ask, is this the right model? But maybe more importantly, was it the right model? So we go back to 2000. And you can try to guess what the rate of return is. I'm going to look at the real inflation-adjusted rate of return of these portfolios. These are using index funds. Conservative investor 50-50, 1.8%. 1.9% real rate of return for a more aggressive investor, and the most aggressive, 2.2%. Nobody's close to making a 4% real rate of return over the last basically 20 years. So the challenge has been that this portfolio model hasn't been right for a very long period of time. It's not what the issue is in the future. And what you're looking at here is an issue about pricing and timing. We're in the business of probabilities. What we try to do is say, what's the likelihood of a series of events occurring? And I want certain things ideally to work in our favor. If equities are less expensive, if the price-earnings ratio are lower than at other times, we have a better chance of making a greater return in the future. So let's take a look. These are the high points, the most expensive points in the market in the last century. And this is today, 2018. The last time prices were this high was 2000. The prices today, the price-earnings ratio today for stocks is higher than it was in 1929. So we took a look and said, all right, let's imagine you believe that your portfolio should just be made up of stocks and bonds, 60-40 stocks to bonds balance. How would you have done after any one of these peaks in the 5 years afterwards? For the next 5 years, what should your expected rate of return be? Net of fees and net of inflation. Well, 0 after 1929, negative 1937, more than a bit negative in 1966, 2000, a little bit of a profit after 2008, decent bounce. The average of every period of time, all of them, and they're all for 5-year periods of time, is basically 0. And your objective is to get a 4% real rate of return. So the odds are hugely stacked against anybody trying to achieve that 4% real rate of return when markets are this expensive in the first place. So it's possible, but it's extremely unlikely. As they say, it's a bit like treading water. Good. So feel for the cat. The other thing, I had this compelling desire to do this. I went to a website, any website. I was just Googling asset allocation. And sure enough, CNN Money, because that's supposed to be one of the places where people get educated about managing money, said, okay, well, just answer these very simple questions and we'll tell you what to do. So when do you need your money by? I said, well, I don't know, 10 to 20 years, I hope. How much risk can you handle? I said, yeah, a reasonable amount. Hopefully not completely stupid. How flexible are you? I guess I could miss the goal by 1 or 2 years. And what would happen if the market sold off? Well, I wouldn't buy like crazy. I wouldn't sell like crazy. Maybe I wouldn't do anything at all. So I said, I just answered these questions. And according to CNN, that makes me a medium-term horizon, medium-term risk, some flexibility. And what does that suggest I should invest in? According to them, 35% large cap, 20% foreign, 20% small cap, 75% stocks. This is as of now. In their opinion, I should have 25% in bonds, 75% in stocks, and nothing in real estate. And this is considered to be good balanced advice. So let's take a look at what the rest of the world does, at least in terms of sophisticated markets. So if you want to get an idea, if you went to Capgemini, you can get a series of reports. This is the last one from 2017, and it explains what people with accounts of more than 1 million of investable assets do with their money, how they invest, why they invest, what services they're looking for. It's a great report, and it's free, so there's no reason to not take a look at it. Here's one slide out of that. This, over the last 5 years, is the average amount of money that this group has had allocated to equities. As you can see, on average, it's under 30%. And if we go further and take a look at other groups, the Wall Street Journal took a look at family offices, which typically have between 200 and 300 million US and upwards of assets to invest, and said, what's your allocation to stocks and bonds together? Their total allocation is 37%. For most people, including CNN obviously, this is 100% is in this box, and there's nothing for any of the other categories like real estate, private equity, alternative investments as well. So, and if we take a look at best practices, again from Tiger 21, that allocate 48% of their funds to private equity and private real estate. Teachers, which David mentioned, a total is 38% between infrastructure, private equity, and real estate. And Harvard has earned a 3% per year better rate of return for the better part of 40 to 50 years as a result of taking an alternative asset allocation approach. And it's generated 200% more in assets over that period of time. So if we take a look then what our asset allocation is, and this is, each client situation has to be different. So this is meant to be a blend of the average of what our clients have done over the last few years. But they've got about 24% of their portfolio allocated to real estate, 36% equity, including private equity as a total, so much less than most individuals. 35, roughly a third in bonds, mortgages, and private debt, and alternative assets allocation, depending on the individual, between hedge funds, alternative strategies, and precious metals. So let's see, we don't have enough data points, but we compare this portfolio that I just showed you to the 60-40 balance for the two periods of time when there was a major stock market valuation, 2000, 2008. So that's the blue line is the returns that are the average returns our clients earned in that 5-year period of time versus what the market offered in 60-40 portfolios. And this is what occurred in 2008 to 2012. So between the two, the difference was around 5.1% per year. And it's the asset allocation that makes this possible. You know, we're still, when we invest in equities, we're still investing in the same markets that other firms are. We just have nowhere near the amount of weights that they would have in these portfolios. Let's take a look at the real estate side of things. And this is one of the things, obviously, we're moving towards that the panel will talk about. What we're comparing here are two things. Publicly traded REITs, which do represent real estate, and IPD, which is a database in Canada, well, in all over the world, actually, that measures the actual transactions of real estate. In other words, what are real estate assets being bought and sold for? There's a very big difference between what a REIT sells for and what real estate sells for. So let's take a look. The two, over the last 10 years, have a very similar rate of return. A slightly better for the actual real estate assets versus the REITs, probably as a result of the friction of costs. What is the best year for hard asset real estate? 17%. For REITs, 50%. What's the worst year? Minus 42. What is it for hard asset real estate in the last 25 years? Minus 2. We're talking now capital, total return value, including both income and capital appreciation or depreciation. The problem here is this: REITs are treated like they're not real estate. They are real estate, but they're not real estate. They are publicly traded stocks, and people treat them that way. So in 2007, REITs traded somewhere around 30 to 40% above the underlying value of the real estate they held. 18 months later, they traded for 30 or 40% below the value of the real estate they held. This had nothing to do with the assets being bought by the REITs. It had everything to do with how investors were behaving. So the individuals affected that price. This is a line graph. The blue line is our own real estate pool since 2005, and the red line is a TSX REIT index. The returns are different. We have earned better returns than the REIT index by a significant margin with a fraction of the volatility. This is what the REIT index looks like as a percentage. These are the percentage changes in value that have occurred, even though the change in real estate prices was nothing like this. So just remember that the challenge with using REITs as a vehicle for real estate is that they are, in most cases, either under or overvalued. Rarely are they actually being sold for the value of the underlying real estate. And that brings us to our own SPIREs. So we have 3 SPIREs, basically, and you can look these up. They're on our website. The first one is the one we set in 2005. It's earned a very solid, roughly 9.5% return since that time. And it manages about roughly 670 million of assets under management. The largest pool we manage is in the US. A large amount of that is in multifamily residential assets all through the US. And it has managed to earn about a 14%, almost 14% rate of return in Canadian dollars, of which about 3% of that is currency, and the rest of it is the actual rate of return of the underlying portfolio. And a few years ago, Mark, our managing director, suggested that we wanted to take a look at directly investing in actual development assets, which we have been doing for the last 5 years. That is a more aggressive strategy for us. It has done extremely well at 16% a year, and less than 50% of the assets are residential. So we're not looking just at developing residential, we're looking at developing industrial and commercial as well, and more recently build to own. So if you want to find out more about any particular asset we have, you can go to the Nicola Crosby website. You can look at this first picture represents all of the locations we have assets, and you can pick any location, drill down for individual assets, and find out whatever details you would like to about how long we've had the asset, what we paid for it, the size of it, etc.